Well, last night there was a big silver smackdown. Should you panic? Should you sell? We're going to do a little analysis here and really take a look at this, and I think you're going to be surprised. So, this is a chart of the silver price. I almost wish it wouldn't do this automatic thing that it does, but here is the big silver smackdown. Silver fell from its high was 29.43 and its low was 27.81. Big overnight smackdown. And then it sort of noodled around today trying to find an equilibrium. But I want to point out, everybody panics on a down day like this. Nobody panics on an up day. There's a big up, unless you're short. There's a big up day there, and it's much less. So this is 6 months of information. There was a bigger down day right here. So we've got a big up day, a big down day. Silver is basically leveraged gold. So if gold goes up a certain amount, silver will go up 1.5 times the amount, 2 times that amount, 3 times that amount sometimes. But it's got the same leverage on the downside. So a lot of times, silver investors get panicked or depressed, but you're less likely if you're an investor and not a trader. This is the type of thing where traders lose. Investors, you don't lose until you exit your position and you exit it and lock in losses. So let's take a look at some of the fundamentals and see what's underlying all of this. So this is Shanghai Gold Futures. This is from Nick Laird at Gold Charts Are Us. And what you see, so here is the gold price, and we're talking, 400 renminbi, I guess, per gram, I think it is. And then there's this plateau here that we've had over the past 4 months, which is great. But we want to take a look at open interest and the volume. We had about 180,000 contracts. This is in thousands, so 180,000. And we're poking our nose over 400,000 contracts, so more than a doubling since 2022. And you can see that lately, this is very high. But let's look at silver. This is the Shanghai Silver Futures, so Shanghai Exchange. What I'm showing you here is the Chinese have your back. Gold and silver are pushed all over the place by the Commodities Exchange in the United States. But when it goes down, the Chinese are buying. But here we have silver, and first, look at the open interest, how many contracts there are, and you're talking about 650,000 here, and we're up at over 900,000 here, 920, something like that. So it's significant, but look at this volume. What has happened in just the past 4 months or so? This is since the beginning of the year, 2024. So this is about 3.5, 4 months, and the volume is way up compared to what it used to be. So, like I said, the Chinese have your back. Again, from Nick Laird, this is the U.S., the commitment of traders. So this is futures again, but it's broken down a little bit differently. It's broken down into the commercials, which is the big bullion banks and the big precious metals, refineries, and so on. And then the non-commercials and the non-reportables. So these are small traders. And if you take the small traders, this line here, and add that to the non-commercials, the red bars, you get an exact reflection of the blue bars. So this is the net. What they're doing is they're taking the open interest here, which has become very high just lately, and they're taking out the net difference of longs and shorts rated by whether they're commercial, non-commercial, or non-reportable. And what you see is that a bull market, so here we are at like 1630 or something like that, 1620, the low 1600s, all the way up to 2400, starting from a low net short position. And what's interesting, though, is this bull run here started at a fairly high net short position for the commercials. So this fairly high discrepancy between the net positions. And it peaked here last week. Now, this is from July 19th, and we won't have the updated information for another couple of days. There's no reason for the Commodities Exchange to hide this stuff for a week, but they do. But let's take a look at silver. So silver did not put in that big blip, meaning that the gamblers that are part of this commitment of traders, the gamblers are a little bit more worried on that silver could explode. This did not exceed the previous week's position. But what you do see here, it was almost down to nothing. In fact, it was upside down here, which I had never seen. This was like a brand new thing that happened in this century. It hadn't happened where the non-commercials were net short and the commercials were net long. That was a brand new thing. But it marked the beginning. This was less than $18. So you're talking the high 17s up to over 32. So you're talking, this is a huge move. These short-term bull markets, they start from these very low positions, and this shrinks. So again, you've got the small investors here, traders. This is on the Commodities Exchange. These are paper. This is fictitious silver that doesn't really exist. And so the red bars plus this line equal the blue line. But we were ready for a pullback. And we've gotten that pullback. That happened, like I said, last night. But I'm giving you some of the fundamentals here. This is weekly transparent gold holdings. And it's all of the published repositories, the vaults, plus the mutual funds and the ETFs. And what's interesting here is gold went from the mid-16s, so you got about $1,650 an ounce back in 2022, to over $2,400, and it's almost all accompanied by net outflows. Selling gold caused the price to rise, at least in the U.S. Why? Because there's other factors at work, and that's the Chinese and the rest of the world, and the world's central banks preparing, getting ready for something, accumulating. And so whenever these people sell, this is the blue line is the holdings here going down and down and down. And then every once in a while, you have some net inflows, but it's rare. And all of this sales and the price rises. So there's other people here that have your back. Here's silver. There's a lot more outflows than inflows. This price rise here was accompanied with these inflows, but I did expect some more outflows. So expect next, when this comes out in just a couple of days, expect some more outflows to be on this chart. But the big story here, global annual silver production peaked in 2016 and it's been falling. This chart goes all the way back to 1930. 2016, and it's been falling ever since, and silver is primarily an industrial metal. Most of it gets used up in industry. Industry needs it. So you're an investor, but most silver still goes to industry. And so you can't have this falling production forever and not have the price rise if the demand on the industrial side is increasing. But here is the big point and what you've got to watch. Here is the gold price over the last 6 months, and you can see that it's been in this range between just under 2,300 up to just a breath away from 2,500. a high of 2482, 2483. So that 2500 is a big psychological barrier. And when it gets past that, I do think you're going to see a lot of buying. But we just recently saw all of these all-time highs. This high in gold was accompanied by crickets. There was no rush toward gold. So there was basically everybody was sort of ambivalent, all-time highs. And you've got to realize the world that we're living in now. Look at the wars. Look at the central bank accumulation. Look at the financial chaos that seems to be going on, where everything seems to be going up and down at the same time. And then take a look at the political situation. Have you ever seen, I was born in 1956. I have never seen an election cycle this crazy. It's everything in the world is just turned upside down and nuts. And gold and silver are the ultimate safe haven assets, and they are coupled. When gold goes up, it will drag silver with it, period. And there's no big damage that has been done to gold whatsoever. And so the thing to watch is the gold-silver ratio. Here it is at 84.85. So we are a breath away from 85. So, I watch it's easiest for me to watch this on my own website. It went up 2.848%, which means silver's value as compared to gold fell by that amount, meaning silver is more of a bargain. And I use this for my buying guide. The gold-silver ratio is my personal buying guide. And so all I see here, until some severe damage is done with gold, and we would have to see it, let's take a little bit longer view here. I'm going to go back 1 year. If it breaks 2,000, we're in trouble. 2,300 is a real good support level. If it breaks 2,000, then maybe we're in some serious trouble. But there is a lot of support in that 2,000 region. I would not expect it to be breaking that. And then, but see, I am in this for the long haul. I am a long-term investor, not a speculator, not a trader or a gambler. So I am watching that gold-silver ratio. And so here is the gold-silver ratio, and Stock Charts has not yet updated today. I'm making this on the 25th. And so I put this just a whisker under 85, right where the gold-silver ratio is. And as, to get a real perspective, the big picture, you've got to take a look at how much of this line is below that blue line and how much is above, and how rare it is to be able to buy silver at such a bargain compared to gold. And then just remember that gold drags this all over the place. So if you're panicked or depressed, you've got to think, well, where is the world headed? Is gold and silver, are they a crisis hedge? Are they a chaos hedge? Do you think that the world is headed toward chaos? And I believe we are overdue for a crisis. So take crisis multiplied by chaos. And that's where we're heading. And I believe that we are headed for far greater gold and silver prices. And what I am looking to do is to be buying silver at these prices and converting them to gold down at these prices, because it's going to revisit that area one day. Don't believe me? Go back to 2011 and ask people if they ever thought that they would see the gold-silver ratio back down in the 30s. Everybody thought it belonged at 60 or so. Well, guess what? Go back throughout history, and what the natural ratio, the ratio for the past few thousand years sort of averages around 13 to 15. And it more reflects the gold-silver ratio, the mineable supplies, the crust supplies. The mineable supplies are probably closer to 8 to 1 or so on. Silver is exhausted, and so I am expecting, this is 1980, when it dropped down below 15 to 1. Well, just take where we are now, 85. So at 42.50, you get, if you sell, you're going to get twice as much gold than you paid for if you change this into gold. If you sell for dollars, you've outperformed gold by double. So that is my analysis. I hope that reassures you a little bit. I'm not panicked. I'm going to be using this pullback to accumulate, to add to my position. I want to thank you for watching, and I hope this gave you a little bit of inner peace. Thank you.